The S&P 500 fell 2.2% on the day, making it a week gain of 4.66%. The Dow Jones fell 1.86% on the day, making it a week gain of 3.75%. The Nasdaq only fell 35 basis points on the day, making it a week gain of 5.4%. In Canada, the S&P/TSX Composite fell 2.1%, making it a week gain of 2.5%. In Europe, the FTSE fell 3.34%, making it a 5-day loss of 2.5%. In Asia, the Nikkei fell 45 basis points. Oil had an interesting day, with WTI slightly up 1.6%, but Brent crude continued to fall roughly 5%. Overall, it's been a pretty rough week for oil. Gold also fell over a percent, but is still up over that 5-day mark. In the treasury markets, the US 10-year and Canadian 10-year both remain at that 65 basis points mark. Looking at that Canada 2-year and 12-year, 2-year is currently at 33 basis points, while the 12-month is at 41 basis points. Slight inversion there. Wonder if that has anything to do with the Bank of Canada's meeting that happened today. In the currency markets, the US dollar had a very strong day, almost up a percent. The Japanese yen also performed well as the Chinese yuan. On the downside, the Australian dollar had a pretty rough day, as well as the Canadian dollar, with the Canadian dollar falling to that 71 cents versus the US dollar, in part due to the Bank of Canada's decision today. It's been hard to say how much the economy is going to shrink due to the global lockdown, and in particular, GDP. We know that the lockdown has been going on for a while and will play a detrimental effect and probably cause one of the biggest recessions since the Great Depression. But it's really hard to speculate what it's going to look like. But today, Spats Canada announced in their flash estimates that in March, Canada's economy shrank a record 9% from February. This would be the biggest monthly decline that they've been recording since 1961. Overall, they expect that GDP will fall 2.6% in the first quarter. IMF is also expecting that Canada's GDP will fall 6.2% over the year. But I've also seen some estimates come out that they expect the economy could shrink from 15% to 30% in Q2 when comparing to the end of 2019. I'm leaning more to on the higher range, closer to that 30%, mainly because I don't see this lockdown ending soon, and I speculate that the longer the lockdown goes, the closer we'll get to that 30%. Just looking at the response from the government, there doesn't seem to be any talk or much desire to reopen things currently, and they still expect it to be a long ways off. But this has been a really rough month for Canada, and it's not going to get better going forward. It'll take a while for everything to recover, but hopefully things don't get too bad. The Bank of Canada announced a meeting today where they plan to expand their asset purchases. They're planning to expand their provincial bonds they purchase by 50 billion Canadian dollars, as well as 10 billion Canadian dollars in high-grade corporate bonds. This brings the total that they're planning on purchasing up to 200 billion dollars. This is actually the first time Canada has done this in their first quantitative easing program, although they are a little shying away from calling it quantitative easing because they say it's more for liquidity reasons rather than trying to get long-term rates lower. I really don't see much of a difference, but anyway, they didn't actually lower rates. Wasn't quite expected to, but the main thing they're doing is just increasing their overall asset purchases. I don't know if this is necessarily the best idea, but at the same time, it's really hard to say what other options they have, and especially with everything that's going on, you got that 9% shrinking GDP in March, really puts pressure on the Bank of Canada to expand their programs and to make sure that they're actually doing something, and in a way showing that they actually have that just increasing the consumer confidence and the confidence of people in the industries. In the United States, US retail sales plummeted an insane 8.7% in March, breaking the previous record of 3.9% that took place during the Great Recession in November 2008. It was expected to only fall 8%, showing that things could be getting worse than even some people are expecting. The areas that were hit quite hard was in the clothing and accessory. They saw a drop of 30.5%, and in home furnishing, they saw a drop of 26.8%. Food services and drink places also saw a high drop of 26.5%. The economy is going to get bad if you haven't noticed yet, and things are just going to continue to get worse. It even says here that JP Morgan is now expecting that in the April to June quarter, the US economy will shrink by a record shattering 40%. That is this massive shrink in the economy. And you see Trump going on about how he wants to open up the economy again. And he gets a lot of criticism for that. In some ways is understandable, but this is the reason why. A 40% shrink in your economy is just insane. It's been an earnings day for US banking industry as the Bank of America announced their Q1 earnings. In total, profits fell 45%. This is mainly a result of a 4.76 billion set aside for loan losses. So their provision for credit loss last year was roughly 1 billion. So they've almost increased it by 5 times already this year. And I expect that considering that that's later in the quarter, as most of January and February won't have as much of an impact. Q2 is going to get even worse. They did see some increase in revenue from their investment banking and trading area, but that's kind of expected, especially with the volatility in the market. A lot of people selling and buying, and because their equity trading revenue was up 39% and their fixed income revenue was up 13%. Also, investment banking fees was at 9.8%. More of a better look, though, to consider when looking at banks, especially Bank of America, that isn't its primary business isn't investment banking and trading, is that our net interest income and actually shrank 2% in the first quarter, which isn't terrible, but 2% drop in net interest income, especially when you consider that was supposed to go up from the previous year originally, isn't a good look, and it's going to get even worse this next quarter. In terms of earnings per share, the bank says they had an earnings per share of 40 cents per share, which didn't beat analyst expectations of 42 cents per share. Goldman Sachs also released their Q1 earnings. Now, they aren't a traditional bank and more focused on that investment banking and the trading side, so they shouldn't be quite as affected the same way as other banks are, but they are still hit pretty hard. The earnings per share came out at 311, but this was actually a beat based off of the analysts' estimation by Zacks Investments Research was expecting a 283 per share. Overall, their trading revenue represents 60% of their overall revenue and actually performed pretty well with fixed income trading revenue up 33% and equity trading revenue up 22%. What took a hard hit though was asset management. The portfolio booked losses of 868 million. They also had an increase in provision for credit loss, which totaled 937 million, which is up from 224 million a year ago or 336 million in Q4. I wouldn't say this is quite as bad as a result of the Bank of America, but really gives you a better look on what's happening in the economy, especially with the lockdown going on and kind of what you can expect going forward. Citigroup also posted their earnings, showing some positives as well as some negatives. As you'd expect, overall trading revenue was up, with their firm's fixed income, currency, and commodity traders generating a total of 4.79 billion, which is 1 billion more than analysts expected. Pretty good result there. But the hard part came from their provision for credit loss was $7 billion, which is a staggering amount, increasing roughly about 3 times. and says here that their allowance for their loan losses is now more than 8 billion higher than it was in December. So they're expecting a significant amount of loan losses. And still, I expect Q2 will be even worse, as a brunt of this will be in the early Q2, while a decent amount will be missed in the Q1. In terms of net income, it fell 46%, and they had earnings per share of $1.05. They missed analysts' expectations of $1.44. Overall, it was a okay quarter, I guess, for the bank, all things considered, because there really isn't much banks can do in this scenario, as they're pretty roughly tied to the economic conditions at hand.